gives me great pleasure to introduce Paul Bridge, Chief Executive of Civitas Social Housing, and also Andrew Dawber, Group Director of Civitas Social Housing. This is a REIT listed on the main market of the LSE with a market cap over £580 million. It currently has a dividend yield of 5.6% and is trading at over a 9% discount to NAV. So with that, I'll shoot on with some questions for the team at Civitas. So first of all, could you please provide an update on the continued growth of the portfolio and how you're achieving full dividend cover now?
Sure. Yeah. Thanks for that. So, as people may have seen, last week we made an announcement that we purchased just under £20 million worth of typically higher acuity properties. And what that did was two things. It used up the balance of the 60 million NatWest facility that we had taken last year, but perhaps more importantly, it got us to a point of 100% cover on a run rate basis, so that we've got ourselves to a steady state. In terms of going forward, then when we make new acquisitions, we'll need to do that from additional facilities that we would take. But just in the round, I think the REIT's in quite a reasonable position now. We have just over 210 million of properties that have no debt on them. We've got a 28% LTV on a gross basis, and we always carry some cash. So we've got about 25 million that's specifically allocated to deals that will close this year. In addition, we never give the exact number out because it moves around a little bit, but we always typically carry 25 to 30 million surplus cash, which we always exclude in a way from the sort of calculations that we make. So we're assuming we're not making any return on it.
Yeah.
And it's a sort of safety buffer.
Yeah. Maybe just for the benefit of the listeners, could you just explain what higher acuity means and what for you?
Absolutely. So it's really important to us actually, because at the end of the day, whilst we look at these buildings as within the social housing sector, they're also in the healthcare sector as well. And higher acuity simply means that the number of care hours that are being delivered into the building is above average. So, what do I mean by that? Then the lowest level of care hours that any individual receives in the building is about 35 hours. I mean, it obviously moves around a bit. We've got 4,500 people in the buildings, and whilst we don't receive any money from the care itself, we're looking at the real estate. It's really important that we understand what's going on in these buildings. We also have people in the buildings who are receiving over 200 hours of care a week. So that's more than one-on-one, 24 hours a day. On average, it's between about 45 and 50 hours a week. And if you look at this sector and refer to it as supported living, then there's no actual definition of the number of care hours that need to be applied for it to fall into this category. The word the government used historically was meaningful. Some people have seen that to mean less than 10 hours. In our view, it needs to be much higher than that to demonstrate that, in effect, the state is getting good value for money, because otherwise these individuals would be in the NHS.
Yeah.
A much higher cost and a much poorer delivery. And obviously at the moment, clearly, from all our perspectives, the NHS is working at more capacity with all these folk not in it.
Yes. And in your recent statement, you also mentioned plans to widen the investment policy. So maybe you could talk a little bit about that in terms of what types of property they are and the counterparties, etc.
Yeah. So the basic criteria remain the same, which is we're providing accommodation for people who have an extra need. It's often a care need, but it could also be people facing homelessness, for example. And it's also people for whom the state has decided that as they can't pay for this themselves, the state and we as a society have decided that we will meet those costs. and we've done that, for the past 25 years. We've entered into discussions with a number of NHS trusts and the NHS itself centrally. These have been going on quite a while. It wasn't driven by the pandemic, although there are a number of specific conversations that have happened because of the pandemic as well. Also talking to local authorities about homelessness. And it seems to us that social housing and supported living are going to be used in a wider variety of ways. So just a simple example, NHS trusts are major landowners in this country. I think the NHS is the second largest landowner after the Ministry of Defence. They've got a lot of car parks, they've got a lot of buildings that perhaps aren't being purposed for clinical use. Yet at the same time, they've often got people who can't leave wards because they're not being supported at home. Step-down accommodation would enable people to come out of wards, to live in premises, maybe for a few months or 6 months, and then go home. They don't need acute medical care at that stage, they just need help. And one of the strategies we're looking at is funding the development or buying on completion for the REIT of those type of properties. It's great for the individual because nobody wants to live on a ward. It's much better if you live in a more homely environment. The NHS, the cost of the individual in step down is a fraction of what it costs to have somebody occupying an acute bed. But perhaps, moreover, there are other people who need that acute bed in any event. So I think what we'll see is that type of accommodation will grow significantly, over the next 1, 2, 3, 4, 5 years. It seems to us that we've got the skill set and the ability, and I think, to be honest, the ethics to be able to work with those type of counterparties in a very transparent way. It'll take time. And what we've said back to investors is we're going to get consent to do this because it's a new development for us. But don't expect loads of deals 5 minutes later, because these are long-term planning things. But unless we've got the permission to do it, then we can't really get involved in the nitty-gritty of these discussions and negotiations.
So could you say something on how you see the leases for these kind of things differing from your current ones? And then in terms of the permissioning, the EGM, when's the timing around that?
So just in terms of timing, we've got to do two things. We've got to get consent from the UKLA. So our advisors have written to the UKLA, and it's a fairly standard process, because this, in a sense, is osmosis. It's not transformational in that the paymasters are still the state, and we're still looking after people, or the buildings are providing accommodation for people who have care needs. So it's an extension of what we're doing rather than something brand new. In terms of the EGM, we're going to call it as soon as we can. Like many companies, we're currently looking at the arrangements for that. We don't have in our Articles of Association the ability to have purely electronic meetings. A few companies do, but it's pretty new. And when our articles came out, that was never thought about. So we're hoping that actually with our lawyers and possibly with government guidance, because this affects many, many thousands of companies, AGMs, it doesn't just affect us. So we would hope over the next couple of months, we'll be able to hold that AGM and we'll be able to get the consent to put that through. I'm sorry, I missed the first piece of the question.
Yeah, just on the structure of the leases for these new areas.
So the leases, if we're dealing with the NHS, then we would expect the leases to be directly with NHS trusts or with the NHS centrally. In terms of length, we would think they would be at least as long, if not longer, than the current leases we have. Because I think the NHS is going to want to feel that these buildings are very close to them, because obviously they're very strategic. They may have reversionary aspects to them. We don't have a problem with that. So we could write a lease, for example, where the property reverted back to the NHS at the end of the lease period. That's perfectly feasible to be able to do that. It just depends on what a particular trust wants to do. If we're looking at homelessness and we're working with, for example, some of the larger homeless charities, which again we've got dialogue with, it could be they would be the counterparty. So we're seeking to be able to work with charities and third sector organisations, and then we already have consent to work with local authorities. So they would be the other potential counterparty if we're looking at homelessness. And as you know, all local authorities have been instructed to move people who were homeless and actually on the streets, off the streets and into accommodation, to help deal with the pandemic. And we're specifically dealing with that in London with a number of local authorities at the moment, and trying to make any available properties that we have available to them for that use.
Great. Well, thanks for that, Andrew. So maybe I'll turn over to Paul now. Maybe you could talk about, obviously it's the topic of the moment. How do you see the potential impact from COVID-19 on Civitas?
Okay, good morning. Thank you, Rob. In terms of the impacts of COVID-19, so the 4,500 people that are housed in Civitas properties are in environments that are, as Andrew said, mid to higher acuity. So what you see is that the structure of the management of those properties is obviously through housing associations and then professional care providers who tend to have very resilient care provision. The reason for that is, of course, that in most cases, in most buildings, the number of carers, individuals that are in the buildings, will actually be greater than the number of people that live there. And also, many people are receiving one-to-one care, or indeed two-to-one care, or three-to-one care. So what that means is, in the unfortunate event of a care provider having to send people home for illness or isolation, it does mean that they've got quite a lot of resilience in terms of providing services. As you'd expect, we've been reaching out to all of our partners, the key care providers and housing associations, and ensuring that they are fully prepared, which they are. It's important to understand that these environments are high hygienic environments anyway, but obviously care providers are making appropriate preparations for dividing buildings and providing isolation for people if they need to. Overall, in terms of the impacts on Civitas, we don't anticipate any negative impact at all. In fact, as Andrew was saying, the opposite, because actually specially supported living is about ensuring that people who could have been in an institution or an NHS setting, or indeed living with their parents with a learning disability, mental health or autism issue, are living properly in the community. And if these people that we currently house were not in our properties, it is quite likely that they'd be using further capacity within the NHS. And as we all know, that capacity is under strain. So what we think is that it's very likely that looking forward, this will continue to strengthen the argument that specially supported living, NHS step down is the solution for the future. In terms of cash flows, obviously, each and every tenant is underpinned by housing benefits. We fully anticipate that that will continue because actually, specially supported living represents a very small proportion of the overall welfare budget. And as we've seen, the government is very keen to support all aspects of the economy, including private rents. So this area has been supported by the state for over 2 decades, and it's, I think it's even more likely that it will continue in the future with the current circumstances.
Right. I mean, have you had any cases in any of your properties so far?
We've not had any reported cases yet. Obviously, I fully anticipate that we will, and there are full procedures in place, both with the housing associations and the care providers, to make sure that that is dealt with. In terms of the client group that we're talking about, the average age of tenants in Civitas properties is 32 years old. As I've said, they tend to have a mental health or learning disability or autism or combination of all of those things. But they don't tend to have significant underlying physical health conditions. Obviously, some do, but most don't. This isn't elderly care. This is care for people who are likely to live a full life expectancy. And so what that means is that we do anticipate that, obviously it will be a very resilient system.
That's a very good point. So, I mean, maybe we should take a step back as well, because obviously there's a longer term story with Civitas as well. So could you maybe flesh out for the listeners the numbers around the sort of demand and supply
Yeah.
for social housing in the UK.
Yeah, I mean, very overall, it's estimated there's over 4 million people waiting for social homes in the UK within specially supported living, which we define as people who require, long-term care and are below pensionable age, are working age, but will almost certainly never be able to work. That cohort is estimated to be at least 50 to 100,000 people. The demand is growing from two ends. Firstly, pleasingly, life expectancy is going up significantly. So now many people with a learning disability are living to beyond retirement age and longer. And secondly, because of better postnatal baby care, it's estimated that the number of young people that are coming through the system with life-limiting long-term disabilities is growing at 5 to 10% a year. So you're seeing a particular area of growth there. This has been highlighted by numerous reports. The most recent was the Human Rights Report published by the Parliament in December of last year, cross-party report, which pointed to the growth, but also pointed to the continual, what it described as containment of young people within institutions when they should actually be in specially supported housing.
Yeah. And maybe you could talk about the sort of regulatory situation, because we did have some issues with a small number of housing associations over the last 18 months. And where do you see the industry developing and sort of changing in that regard?
The regulator continues to work closely with a small number of housing associations, and obviously it's on record about the housing associations that it's working with. And the key things the regulator is looking for is improvements around governance and management. And what we're seeing is, and we've actively promoted, is a real improvement in skills across those organisations. So over the small number of housing associations that operate this model, there have been nearly 40 new board members from a variety of backgrounds, financial, management, professional, social housing, attracted to the sector in the last year. There's also been much recruitment around senior staff. We've seen a number of new chief execs start coming from the mainstream sector, because actually they can see this is a real growth area, a real area of high demand, and actually it suits the type of person who has professional skills but also really wants to touch and feel improving people's lives very, very quickly, because you do see that very, very fast with this. Once you're in communication with families and then moving people into homes, you can see their lives starting to transform very quickly. We have regular dialogue with the regulator. We're not regulated by them, but I think, I can't speak for the regulator, but I think we're regarded as a good citizen. We've set up the Social Housing Family Community Interest Company, which has a partnership with its first housing association, Auckland Home Solutions. And the intention is that CIC will have partnerships with other housing associations with the intention of improving their professional standards of management and governance, and also to potentially share services moving forward, because obviously there are probably around 35 organisations providing these services, and I think there can be greater professional economies of scale achieved by collaboration.
Right. And coming back to something that Andrew talked about was your gross gearing is 28, but I think you like to think you can go up to 35. So could you say something about how your pipeline and what opportunities there are in the near future?
Yes, I mean we do have a good pipeline of opportunities. I think because we are the largest player in this part of the social housing market, anybody who's really looking at a development or wants to sell properties at completion, I think we see a large part of that market. So we're regularly contacted directly by parties, whether it be local authorities, major care providers who look at divest properties, or in fact developers who look at us acquiring new properties at completion. The REIT doesn't forward finance, as you know, but that doesn't stop us buying brand new properties. So we're a fairly obvious phone call, I think, today for all those sort of counterparties. So we have no shortage of opportunity. In terms of funding that, over the last few months, as we said to investors, we've had a number of dialogues running with lenders, both existing and new. We've received indicative terms for new debt, which would take us up to or close to the 35% gross LTV, but we're not going to pull the trigger on that in the next few weeks. Pricing, even though it's been through credit on the bank side, we want to have a few alternatives, which we've always wanted to look at in terms of getting the right sort of facility. But also, it's very difficult to price something today. Spreads in the banking market are very volatile. We've no need to do that. So, as we say, we've got cash. We've got over 200 million of properties with no debt on them. We've got a covered dividend. So, we can take our time and do this sensibly. But if we look a little bit more strategically, then we can put on up to another 120 million of debt onto the existing equity base to get us to the 35%. And we can use that to invest in new properties before we need to think about any form of equity raise. So I think we're in a decent position from the point of view of looking forward, and I think the market can see we're a significant entity in this sector today.
Brilliant. So I'd like to thank Paul and Andrew for that review. Actually, Paul or Andrew, is there anything else you want to add to sort of summarise, or are you happy there?
I think we're happy. We wish everybody to be well. That's all.